Market's still really being driven by Sydney and to a lesser degree Melbourne. Over the last year, Sydney home values are up 13.2%, Melbourne's up just around 8%, and then the next best performing capital city is Brisbane, up 6%. But I think the interesting thing is the rate of growth in all capital cities, except for Hobart, is actually now starting to slow and is lower than its peak. So we're seeing that the market's actually moved through its peak growth phase. It's slowing fairly, at a fairly moderate pace though, and obviously Sydney's still seeing comparatively very strong growth. So the overall performance of the market's really being dragged higher by Sydney and Melbourne, and obviously as the two largest capital city markets, they have the biggest influence on the overall performance. It's already starting to slow, but as far as tapering off, our view is that we're still going to see growth next year. Who knows? There's a lot of talk now that the next interest rate movement may actually be down rather than up. Obviously because the rest of the economy is not looking particularly strong. So we think that next year we'll continue to see growth, but it'll be at a much more moderate pace. It's looking like by the end of the year, capital city value growth will be somewhere between 7 and 8% at a national level, and we are expecting that will probably slow to about 3 or 4% next year, with Sydney and Brisbane the strongest performers. Melbourne, Adelaide and Hobart still seeing some level of growth, and potential falls in Perth, Darwin and Canberra. I definitely think that's a risk, and we saw a couple of years ago Glenn Stevens talk about the fact that they're looking for housing construction to pick up as mining construction slows. But if you have a look at the construction work done data which came out last week, it showed that residential construction work fell. Dwelling approvals data showed that approvals are now 15% lower than they were at their peak. They're still high on a historic basis, but the concern is we've already now passed through the peak in dwelling approvals and construction activity, so we won't get that sustained boom. You need some level of capital growth to drive developers to go and build new stock. But the other interesting thing in this current phase as well is we're seeing a lot more units built than houses. So I think they're less likely to ultimately be built because obviously a high density residential development has a lot more risk than building a single house. So I think we do, if we push rates lower, we do potentially run the risk of relying too much on the housing market. But the Reserve Bank is inflation targeting. They don't target housing market or the mining sector or that. They have to have a macro view. I don't think they would cut rates until such time as they introduce whatever macroprudential tools they do introduce are in place and implemented. Well, it depends how much more expensive they potentially make the mortgages, but if it's only 5, 10, 15 basis points, it might be a deterrent for some, but I think realistically with interest rates so low, there's not much point keeping your money in the bank at the moment. If you've got debt, obviously your other option is to pay off the existing mortgage you have. Your effective interest rates are a lot better there. But if you're a true investor, I think that even if it costs a little bit more, the housing market's still attractive. Share markets are still not even back above where they were in 2007. I saw today that bonds are below 3% now. So there's not very strong returns across many asset classes, but obviously investing in a market like Sydney, for example, you've seen 13% capital growth, you've seen 4% rental return, your total return from property is pretty strong. So yes, that might moderate a little bit, but I still think it's better than most other asset classes. So I don't think it will be that too much of a deterrent. I don't think at a macro level. I know from talking to a lot of the banks, they're looking at getting, better understanding of their concentration risk and not having too much exposure in one market. Obviously, we know investors are very active at the moment. They're very active in inner city areas, and I think that's a potential risk. But I think if your loan book is well managed, spread out throughout the whole state, whole capital city, there's not so much of a risk. I guess it's really just making sure that when someone's lodging an application, that they have the ability to pay it back when if they lose their job for a little while, when interest rates are a lot higher. I think there's better ways to mitigate risk than just saying categorically we're not going to lend here, we're not going to lend there. It's just being a bit smarter about it. So understand that that's their model of going for it, but I don't think too many other banks would be looking at a similar model. Obviously there's too much business to write in Sydney and Melbourne.